Employees can contribute pre-tax dollars through payroll deduction. The amount an employee contributes to the 403B from pre-tax dollars lowers taxable income. For example, if an employee is paid $1,000 but contributes $100 to a 403B, only $900 will be subject to income tax. The employer may match employee contributions up to the limit specified and/or contribute money to employee's fund. Also, the employer may contribute to the employee's account even if the employee doesn't. Like the 401k, the investment amount and growth are not taxed until funds are withdrawn. Withdrawals are allowed in cases of termination, death, disability, or if the company allows it upon hardship. A 20% additional tax usually applies to any 403B dollars taken directly in cash at the time of retirement or termination. To avoid this penalty, the dollars can be directly rolled over into another tax-qualified plan. Roth 401k and Roth 403b. Beginning January 1, 2006, plan sponsors of 401k and 403b plans could offer a Roth feature for employee salary deferrals. The growth of a Roth 401k or Roth 403b is tax-free, which means you will not have to pay income taxes upon withdrawal as long as certain criteria are met. Contributions and withdrawals. If the Roth is offered, participants have the option of making plan contribution in 3 different ways. Pre-tax basis to a traditional 401k, Roth basis to a Roth 401k, or a combination of the two. Only employee elective deferrals are available for Roth treatment. All employer contributions to qualified plans will remain pre-tax. It is important to remember that contributions to a Roth 401k or 403b will not lower your taxable income as a conventional 401k or 403b contribution will. Contributions are irrevocable once they are in a Roth 401k or 403b, and they cannot be shifted to a pre-tax account. An employer contribution will continue to be made into the pre-tax 401k, 403b account. Roth 401k and 403b accounts have higher annual contribution limits than Roth IRAs and no income limits. The plan rules that govern withdrawals from regular 401k and 403b plans will also apply for Roth 401k and 403bs. Withdrawals are allowed in cases of termination, death, disability, or if the company allows it upon hardship. Cash withdrawals prior to age 59.5 may be subject to a 20% additional tax. When you leave your company or retire, the Roth portion of your 401k and 403b could be rolled over directly to a Roth IRA where it will continue to grow tax-free. For a withdrawal to remain tax-free, the account would have to be held for 5 years and the account owner would have to have reached 59.5 years of age. Upon reaching age 70.5, you must start taking withdrawals from your Roth 401k or 403b no later than April 1st of the year following the year in which you reach age 70.5. Annuities. An annuity may become an important part of your retirement savings plan. Annuities combine an investment vehicle with an insurance contract. The purpose of the insurance contract is to protect the designated beneficiary against loss of capital, but it also enables the investment to grow tax deferred. One drawback is that most of the assets cannot be assessed before age 59.5 without a 10% additional tax. Also, capital gains are taxed as ordinary income when distributions begin. The purpose of the annuity contract is to create an invested pool of money to provide a series of payment and income stream to the person named as the annuitant in the contract. Payments, usually monthly, may be for a designated period of time or for the life of the annuitant. There are several persons named in the annuity contract: the owner, the annuitant, and a designated beneficiary. In most cases, the owner and the annuitant are the same. The beneficiary is the person designated to receive the proceeds of the contract, if there are any, following the death of the annuitant. Two major types of annuities are deferred and immediate. Deferred annuity provides income at some later date, at least a year away. There are two phases to deferred annuity: the accumulation phase, in which the owner makes investments or payments into the annuity, and the distribution phase, in which the annuitant receives income. A fixed annuity pays a fixed interest rate which is guaranteed by the issuer, the insurance company. The payments to the annuitant are based on a set formula. This category has a lower risk than the variable annuity because the risk is assumed by the insurance company. A fixed annuity may be immediate or deferred. A fixed annuity might be appropriate for a person who wants a guaranteed monthly income and is risk-averse or simply concerned about outliving his or her assets. For example, a retired person who has already accumulated assets. A variable annuity is only offered as a deferred type of annuity. This category does not have a fixed interest rate. Premium payments are generally invested in a separate account similar to a mutual fund. The payments to the annuitant are based on the performance of securities held in the separate accounts. There is market risk in variable annuities, but there is also the potential for greater growth. The investor assumes the risk in this type of annuity. A variable annuity would be more appropriate for someone who is interested in accumulating assets for the longer term and is able to handle the risk. An easy way to remember the difference between fixed and variable annuities may be to compare them with CDs and mutual funds. A fixed annuity with low risk and a guaranteed interest rate is similar to a CD, while a variable annuity with higher risk and a higher potential return is more like a mutual fund. Neither fixed nor variable is inherently better than the other. Each has purposes for which will be appropriate. Immediate annuity is purchased with a single lump sum payment and provides income immediately or within 1 year following purchase. In an immediate annuity, there is no accumulation phase. The distribution phase starts immediately. It must be a fixed annuity. Cancellation or exchange. As long as the owner is alive, he or she has the option to cancel the annuity contract at any time before the annuity period, the beginning of the distribution phase. The issuer may impose a termination penalty. Upon cancellation, the assets of the annuity, minus any penalties, will be returned to the owner. The owner also has the option to exchange the original annuity for another annuity without tax consequences at a different issuing company. This type of exchange is known as a 1035 exchange. Annuity withdrawals. Withdrawals can be made from annuity during the accumulation period. Annuity contracts generally allow withdrawals of 10 to 20% of the assets annually. Withdrawals may be subject to a withdrawal charge depending on how long the assets have been in the annuity. Since withdrawals are made on a last in, first out basis for income tax purposes, the first amounts withdrawn are usually earnings on which taxes and penalties for withdrawals before age 59 and a half. Withdrawals may be treated as a reduction of assets or as loan requirement, repayment, and interest. Details on the use of this option may vary from one annuity contract to another. Advantages and disadvantages. Some advantages are no limit to contributions, tax deferral on earnings until withdrawal, potential for lifelong income, investment flexibility, insured investment. Disadvantages: no capital gains tax advantage, no residual estate, penalty for early withdrawal, expenses, no step-up cost basis for beneficiaries. Are there any questions?